The world is currently navigating an active geopolitical minefield. We have live conflicts escalating in the Middle East, specifically the tension between the US and Iran, and widespread economic uncertainty gripping global markets. Yet, amidst this chaos, the assets historically designed to protect capital from instability suddenly fractured. Gold slammed hard into a resistance wall at $5,200, while silver suffered a brutal 13% collapse in just 2 weeks. If you check the financial news, you hear the exact same lazy explanation repeated on loop. The pundits immediately slap a routine pullback or risk-off label on the trading charts and tell their viewers to move along. But that explanation ignores the actual data. When the mainstream narrative fails to explain the sheer violence of the price action, a much larger structural shift is moving beneath the surface. To see that shift, we have to look to the east. China's largest state banks, institutions like the Industrial and Commercial Bank of China, the very backbone of their financial system, just imposed daily aggregate quotas on accumulated gold purchases. They literally shut down the ability for their own citizens to buy gold once a morning limit is hit. So while Western media tells the public the metals market is simply cooling off, the Eastern reality tells a highly localized story of panic. The Chinese banking system is buckling under such massive physical demand that it has to lock its digital doors. You do not ration an asset if supply is comfortable. You ration things that are under immense pressure. Rationing is the ultimate proof that physical supply is moving faster than the financial system can safely handle. The mechanics behind this rationing reveal exactly how fragile the setup is. These citizens aren't buying physical bars sitting in a segregated vault with their names on them. They are getting bank-mediated exposure, meaning they buy paper claims, and the banks must constantly chase physical supply on the Shanghai Gold Exchange to back those positions. When millions of retail buyers flood in simultaneously, delivery queues stretch out to 15 working days. If the banks can't source the metal fast enough, it creates massive balance sheet risk. The pressure gets so intense that regulators are forced to freeze the inflows entirely to protect the system. And here is where the situation becomes truly hypocritical. While everyday citizens are told they've bought enough gold for the day, the People's Bank of China has been quietly and aggressively adding to its official gold reserves for 16 consecutive months. We are watching a two-tiered reality unfold in real time. The state secures physical wealth for its own reserves, while actively suppressing civilian demand to keep the domestic delivery system from collapsing under the weight of its own citizens' capital. Meanwhile, the Western silver market is experiencing an entirely different kind of stress. Silver took a brutal 13% hit. Yet during the exact same geopolitical crisis, purely speculative assets like Bitcoin rallied, adding $240 billion in market cap. This visual comparison exposes an extreme mispricing. The semiconductor company NVIDIA is now on the verge of being worth more than the total value of all the silver ever mined in human history. Keep in mind, silver is the exact component that allows those NVIDIA chips to function. It is required for the massive data centers that power AI. It is inside critical medical devices, and it is a necessary component in the active military defense systems currently deployed in global conflicts. We are talking about a scarce, highly conductive physical metal that sits in vaults and powers supply chains, contrasting heavily with the purely speculative nature of its paper trading price. The idea that the foundational metal keeping modern civilization running is valued less than a single tech company highlights a deep market detachment. The system is pricing in algorithm-driven momentum and completely ignoring the tangible commodities that make the modern world function. So why did the price of silver drop 13% if the physical demand is so high? The answer comes down to a mechanical failure driven by leverage. Leverage is when retail investors borrow cash from their brokers to multiply their bets on a rising price trend. When investors are heavily leveraged and a sudden geopolitical headline hits over the weekend, brokers issue margin calls demanding more cash to cover the risk. If the investors don't have the cash, the broker forcefully sells their positions. That automated selling pushes the price lower, triggering even more margin calls and creating a violent, self-feeding downward cascade. These sharp paper market crashes are rarely about a change in the metal's actual real-world utility. They are algorithmic chain reactions designed to clear out over-leveraged positions. acting entirely independent of the physical scarcity of the asset. When the dust settles from one of these flushes, the paper charts look like a bloodbath. But in the physical world, absolutely nothing changed. Not a single new mine opened up, and the technology factories didn't stop needing silver. The entities waiting at the bottom of that cascade are deep-pocketed institutions and central banks. Because they hold deep cash positions and do not rely on borrowed margin, they sit patiently and buy up the heavily discounted physical assets that retail traders were just forced to liquidate. A drop like this is a highly efficient, brutal transfer of wealth. It strips the metal away from impatient, over-leveraged traders and moves it straight into the vaults of patient, long-term accumulators, which leaves every investor with a stark choice. Are you going to let the short-term red numbers on a trading screen dictate your actions, or are you going to align your strategy with the undeniable structural reality of physical scarcity? Surviving a volatile repricing event requires strict discipline. The absolute golden rule in this environment is that you must hold your positions with deep cash and avoid using leverage at all costs. When Eastern state banks are rationing delivery and Western media is telling you the market is perfectly fine, one of those stories is false. Ignore the paper noise, anchor your strategy to the raw physical data, and let the panic of the paper markets become your long-term advantage.